All right, we're live. Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us today. It's great to have you all with us. FounderLine is all about helping people with their startups. And you might be someone who's thinking about starting a company, or maybe you've started a company and you're facing an issue that you're trying to deal with an employee or with a funding or something along those lines. Maybe you're thinking about joining a startup and you have a question about a company and you know, what about the offer? What should I do? Those sorts of things. Whatever it might be, we're here to help you today. And this is a live show, which means we're available to take your questions right now. The best ways to reach us are via email. Our email address is help@founderline.com, or you can tweet to us. The Twitter handle is @FounderLine. With that, let's get started. Our guest today is Kent Goldman, who's the founder of Upside Partnership. Kent was an executive at Yahoo and then a venture capitalist at First Round Capital. He's invested in a bunch of great companies, including Airware, Hotel Tonight, and Liftopia. Kent, welcome, and thanks for joining us today.
Thanks for having me.
Great to have you here. I know you're a busy man, so really appreciate you taking the time.
My pleasure.
So usually I'll start off with a few questions just to warm you up, and then we'll dive into questions from the viewers and the listeners. You know, you were at Yahoo for almost 4 years?
Just about 4 years.
And you know, both on the product side and then in corporate development, also known as the M&A group,
Yep.
right?
Yep.
Especially in light of what's going on in the market right now, founders are always wondering about, like, how does the acquisition process work? Like, you know, Yahoo decides to buy company X, or Google, or any one of the big, you know, Nest buying a company. You know, can you give us some insight into how a company like that identifies, you know, the companies to go after, and then, you know, what happens once they decide to do that?
Yeah, so I think my time at Yahoo is, I think now 6 CEOs ago. So you know,
that is amazing. Is that true?
Yeah, I was with someone yesterday who had gotten to Yahoo just after I left, and they said they'd been through 5. So I'm assuming sort of like,
wow.
You know, that was, you know, when I was there it was six ago, perhaps more. But you know, so just speaking sort of very generally,
yeah.
It's sort of like a lot of these things. It just comes down to the very, very basics, which is like, have a good product, have a product that people like, understand for every time sort of you meet with an acquirer, understand how that could fit in, you know, into their business and how it could be valuable. And companies will find sort of like unique value in each, you know, in each one. But you know, I do think sort of it's important while you're building a company, if you think you might be, you know, going towards an M&A exit, which most companies do, it's just good to sort of be gently reaching out to people at larger companies, sort of you know, as you're developing it. And you know, I say this sort of as a former corp dev person myself, so with all deference to people sort of currently in those roles, it's better to reach out to people on product teams. In my experience, it's generally, you know, product people, engineers who champion acquisitions, and the corp dev team can sort of help get a transaction done, but nothing gets done without sort of like the heartfelt sort of belief and commitment of the operators.
Got it. And so, you know, there's this saying, you know, companies are bought, they are not sold, right? And so, if you're one of these companies, you know, running out of cash, you know,
it's too late.
It's too late. So by then, they're not interested.
If you're running out of cash, it's probably too late to get a great price, because the key to any sale is to make sure you have some measure of leverage. And as a seller, the ways you get leverage is to either have multiple bidders, or to not need a bidder at all, and to just be able to say no. So if you're running out of cash and you're facing a bit of a brick wall there, it's going to be tough to optimize your returns.
Yep, makes sense. All right, so you left Yahoo, you went to First Round Capital for about 4 years, and then you decided to break out on your own and start Upside Partnership.
Yeah, it was actually I was at First Round for just about 6 years.
Oh wow!
So I joined First Round in 2008.
Okay.
Just after the 4 founding partners had raised the first institutional fund. And really that was a time when the seed ecosystem was just getting going. In fact, I remember when I had the job offer, I reached out to a friend who was a GP at the Sandhill Fund and said, I have this offer, what do you think? And the response that I heard from him was, well, first on, they've got this crazy little fund and they're investing in seed stuff, and none of us quite really know what they're doing. We're not really sure we get it, but the easiest way to get a job in venture is to already have a job in venture. So you should go and do that, and in 3 months start looking for a real job. And I'm proud to say I don't think anyone would say that about First Round now. I think it's sort of been built up into probably certainly the preeminent brand in seed, if not one of the preeminent brands of in all of venture. So I joined in 2008, originally joined as a principal, figured I'd stick around for 2 years, and then I would either go off and start a company or join one of the companies that we'd invested in. 2 years went by, we all sort of looked at each other and said, wow, this feels pretty good. And I was liking what I was doing, so I became a partner, and for a long time thought that I would be at First Round for the rest of my career. But you spend enough time around founders, and ultimately sort of, I don't know if you get the itch or the courage to become a founder,
the insanity? Is that what you meant? I think that's what you meant.
Yeah, you want to be part of the club, not just a cheerleader. And so, with that, I had some ideas about how the seed market had evolved from those earliest days, and I wanted to sort of try them out on my own. And so, sort of, thankfully, sort of with the blessings of my former partners, I set off to form Upside, which was, from the get-go, meant to be a very different type of venture fund than what, or a very different type of seed fund than what First Round was.
Cool.
In part because I would never want to compete with them.
Yeah. And so how are you guys different? Like, what's the focus?
So if you go back to some of the earliest days, in the seed world, really syndication and what I'd almost call today sort of like equal syndication was a big part of the business. So I can remember, in the early days of TaskRabbit, going into some of the board meetings, and from First Round we had 2 people. Steve Anderson from Baseline was there, Anne from Floodgate was there, and she'd usually bring an operating partner as well. And so you had really sort of 3 of the preeminent seed funds all working together. First Round, we actually missed on our first pass looking at TaskRabbit, and I kept reaching out to Leah because I wanted to get a meeting. When she wouldn't return my calls, I reached out to Anne at Floodgate and said, "We'd love to be involved. Can you help us?" And the response was, "Oh yeah, we'd love to work with you." And I think over time, as seed funds have gotten bigger, and sort of depending on sort of which firm you look at, there if you go back to that original cohort of seed fund, they're anywhere between a lot of them are sort of close to 5 to 6 times larger than they were in 2008.
Yeah,
it's become much harder for those funds to syndicate and work with one another. As funds get larger, there are increasing pressures to write larger and larger checks, to have larger and larger ownership stakes, which makes it harder and harder to work together in sort of a true 2-handed or 3-handed partnership.
Got it.
And that was something that I missed. I always sort of felt very lucky that within First Round I was surrounded by great partners and mentors, but I always felt that Steve Anderson was one of my closest mentors. I always felt that sort of Chris Sacca was someone that I could talk to and get advice from. And I wanted to go back to a place where I could have a fund where that felt sort of syndicated and those sorts of partnerships felt very, very natural. And so I had this idea that if you had a fund which was purposely designed to be small, you could not only you could be a syndicate partner of choice and work with a lot of the great sort of like the great funds that were out there, but you could also sort of write small checks, which again, as seed funds got larger and larger, it became harder and harder for them to participate in what I think of as a true seed round, basically a friends and family type round.
Right.
When you have a $70 million fund, it's very difficult to rationalize writing a $150,000 check. And so I wanted to be in a position where I could independently write the $150,000 checks and work with founders when they have just an idea on a napkin. And I also wanted to work with sort of a lot of the people who sort of mentored me in the business, be it at first round or other. And so I thought that by having a smaller fund, it'd be a great avenue to do that, and it'd also be a great way, frankly, to be able to cherry pick some of the best opportunities
Sure.
In the business.
Well, and it's sort of led to this this weird nomenclature issue now, right? Like where seed is like a little bit further downstream. Now there's pre-seed, or I don't know if you call yourself seed or pre-seed, but it's a little weird to me. It's just like, why do we have to come up with a new name?
I mean, we have to come up with a new name because I think that the goal stakes have moved. But frankly, I don't worry that much about. I don't worry that much about labels. I'm happy to invest with sort of founders which are working, that don't really have a full product plan yet, but they have an idea. I'm happy to invest there. I'm happy to be the only institution around, and I'm also happy to sort of invest a little bit later. In fact, at Upside, we've now been investing out of our current fund for a little bit over a year, and since we closed the fund, we've made 17 investments. 9 times out of 17, we've actually been the first institution to commit.
Wow.
Which is something I'm very proud of. And to me, this goes back to the idea that to play a leadership role in this investment syndicate, you don't have to be the lead. You don't have to have your letterhead on a term sheet. It just doesn't matter.
Cool. Awesome. So let's talk a little bit about the markets. So China and U.S. stock markets have been going a little crazy recently, and all this talk about bubbles and corrections. And I mean, if you want to talk about whether you believe that or not, that's fine. But mostly, what I want to know is, what advice are you giving to the founders of the startups you're working with? As they see this sort of stuff, anything you're telling them to do differently. You remember the RIP good times from Sequoia way back when, and Bill Gurley's been going on, Bloomberg and other places sounding the alarm bell. Might not be relevant to the companies you work with, but what's been going on?
I'm basically telling founders sort of what they've been hearing from me right from the first time investment, which is you're building a company over a 10-year period, and if you're doing that properly, you don't have to worry or think about, or you shouldn't be worrying about the public market, certainly sort of at the seed and the Series A stage. Instead, think about controlling your burn, growing in a rational way, and frankly, with as you raise subsequent rounds of funding, don't optimize for the don't always optimize for the highest valuation. Oftentimes, when you do that, you're setting the goalposts, or you're setting the hurdle you have to clear a little bit too high. You're not leaving any room for error, or you're not leaving any room for the markets to correct. Yep. And it's funny when I say that to founders, I often sort of remind them that sort of as a seed and Series A investor, when you talk about taking lower valuations in later rounds, like a Series B round, I'm taking dilution right along with them. Yep. But I would much rather see the company sort of set up for success over the long run. You don't make money on interim valuations.
Well, exactly. Although people like to keep score, so
that's the wrong way to keep score.
Yeah, exactly.
That's the impatient person's way to keep
I
score.
know. Well, and I always tell people, like, I remember being at companies and like a new competitor shows up, right, and everyone freaks out, and it's like, let's just keep our heads down. They're going to be competitors. Like, it's who executes the best, and just like, let's keep going.
If there aren't competitors, you're probably not in a good market, right? So, but a lot of this comes back to sort of, as a founder, what you want to be able to do, what you want to do is focus on the things you can control and you can influence. You can't control whether or not there are competitors in the space. You can't control what's going on with the global equity market. Yep. Instead, you can just focus on building a great product and operating your business in a sane as manner as possible.
Yeah, I actually think in a way it'll be good for everybody. Yes, valuations might come down a little bit, so you can't get 20 pre on your seed funding company where it's on a napkin, right? But you might be able to hire a little bit more easily. Maybe rents come down in Soma and Palo Alto. So
look, there will be some real pain in the people who go through, who sort of go through layoffs or find themselves with options that are underwater, and have always, you're going to have people who've always done great work. They're just in unfortunate situations. It will be very painful for them, and there's no sense sort of minimizing that. But I think sort of other founders, especially those that are sort of in the earlier stages of their business development, can heed those lessons now.
Yep. All right, well, why don't we take some questions and see if we can help some people out. Remember, you can email us. The email address is help@founderline.com, and you can also tweet to @founderline. So let's dive in. First question is from Rick in Boston. It says, today's New York Times has an article about there being too much capital available right now. A quote from the story follows: a paradox of investing. Bad times feed good ideas, which in turn leads to good times, which breed complacency, waste, and lots of bad business plans. Do you anticipate a market correction? Do you think this would be a benefit? So we just talked about some of this, but what do you think?
Yeah, most seed investors that I know really began talking about some of those characteristics probably back in January. And sort of, with upside, I think sort of through the spring, it was something I began to feel sort of more and more acutely. And the last investment we made was actually, the last commitment we made was in May. That investment happened to close in June. But given sort of the pace that we'd been on, it has been sort of like a market slowdown, in part because we were seeing a lot of derivative ideas. And for me, the hallmark of that is when you see a blank for blank.
Right.
Just no.
And the blank is not a public company or
yeah. And a lot of this goes back to sort of what I'm trying to do with Upside, and I try to focus on what I call finding purpose-built founders. And these are people, when you sit down, you talk to them and say, like, why are you building this business? Like, why are you taking the chance to start a company when you could probably have a very lucrative, role at Google or somewhere else? Why are you taking this sort of career risk? Why are you putting yourself through this stress? Why are you putting your family through this stress? And they'll say, you ask that question when you get an answer, which is about someone sort of, pursuing something which they sort of felt very deeply. So Jonathan Downey at Airware was when I met him, it was a lightning bolt. He said, why are you building a drone company? And keep in mind, this was well over 2.5 years ago, so drones were not as big and well known as they, it wasn't sort of quite a trend that they are today. But he said, my grandfather was a pilot, my father was a pilot, my father met my mother teaching her how to fly. I've been a pilot my entire life. I went to MIT to study automated flight systems. I went to Boeing so I could keep working on them, and I had to start this company because at Boeing I couldn't innovate fast enough. And sort of like, all right, I don't know if there's a market there, but if anyone could build this company, it's him. And for me, that was such an instructive point in my career, and that's really what I look for in every, with every founder. And so when you ask that question, why are you starting this company? And someone says, well, I stepped back and I saw a really big market opportunity. Sort of, no. It might be a fit for someone, but it's not a fit for me. And it seemed like there's been a lot of those.
Yep, makes sense. All right, well, Rick, I hope that answers your question. Let's move on to Paul in San Francisco. He says, if you're joining a startup of about 50 people, how can you really tell if they're doing well? So great question, right? Like I often tell people, you got to do as much diligence on the companies you're joining as they're doing on you, and frequently that's not the case. Yeah. Also true of founders taking money from investors who don't do any due diligence.
Frankly, often true of investors giving money to founders.
Not the good investors like you or me, but you're right. Yeah. I mean, sometimes it's crazy. I'm like, how could they not have called me about that situation? Yeah. Like I'm probably the person who knows the most about that, and the phone never rang. Anyway.
The first thing is ask, right? If you're taking a career risk and you're joining a startup, I think it's a very fair question to ask the founder, to ask the CEO, or if the company is large enough that your primary interactions are with an HR person, say, help me understand, what are the finances, of the company? Help me understand how much runway we have. Help me understand, are we on plan or not? And if you don't get great answers to that, it could be that there's a sign that there's something wrong in the business, but it could also just be a sign that there's something wrong in the culture. And I think sort of the best startups tend to have fairly transparent cultures, especially at the 50-person plus stage.
Sure.
And so if they're not willing to share some of those details, I think it's a bad sign. The caveat to that is, in your first interview, that's not a fair question to ask. Like that, I mean, that is information which is sort of justifiably held private. But when you get to the offer letter stage and you're seriously considering it, those are very fair questions to ask. And that's exactly what I would do.
Yeah. Well, and I think the company will respect you more because they're like, oh, he's kicking the tires, like he's trying to find out what's going on.
Well,
here.
I would say you're acting like an owner.
Yeah.
Which, as a startup employee, that's the only reason to go to to go to a company is to get an equity stake and be an owner.
And the other thing, we saw this situation with Zirtual, which I don't know if you're part of or not, but like it's really weird, to sort of run out of money without totally understanding what's going on. Like that's kind of a scary thing at that scale, right?
Yeah.
They're a pretty big company, so it does happen. Like companies don't always know exactly what they're doing. So.
Yeah, I'm not an investor there, but that is one which is it's puzzling.
Yeah,
it's puzzling.
Yeah. So do your homework. Whether you're taking money from investors or you're joining a company or you're investing, whatever it is, like it's okay to call people out of the blue and say, "Hey, I'm thinking of joining X. I saw you worked with the CEO 5 years ago. Yeah. Would you be willing to tell me what you think about him?" Like that's fair game. It shows, and if word ever gets back, like whenever that's happened to me, I have more respect for the person. I'm like, oh, they're checking me out. Like they're doing backdoor references, and so
you're making a serious life decision.
Yes, very, very serious.
Yeah.
All right, so let's move on. This one is from Michael in New York. Given rising valuations, how do you deal with a situation where you are uncomfortable making a follow-up investment because the price is too high? How do you avoid any negative signaling? So I don't know if you guys do pro ratas like all the way through or not, but it's a great question because you're always worried your existing investors, they know more than the new guys, and like, oh, well, what if the existing guys don't want to put in the money? You know?
It's something I think about a lot. So with Upside, we're a little bit, our fund size is a little bit more than $30 million. More than 70% of the fund is set aside for follow-on. So if we participate in a seed round, we definitely want to get our pro rata, or we'd like to participate on a pro rata basis in the A and possibly the B. The number one way, I think, to combat signaling risk is I try to sort of be very communicative, even at the seed stages, about, what are the sort of the white lines where it becomes difficult for, our fund to participate.
Yeah.
And we've been lucky. We've had some unannounced follow-on investments, which have been, for companies which are doing phenomenally well. I think the world of the founders, but they sort of, they got to that other side of the, of some of those lines, and for them it wasn't a surprise because I was in sort of constant communication with them. So number one is I do whatever I can to not surprise the founders. But I've also found it helps during a fundraising processes as an investor, as I'm getting inbound, to be very clear with sort of the other people I know in the venture industry about sort of, where some of those lines and those markations are for me. And when I always take the time to sort of walk people through the math of my fund and how I've been thinking about it, and they all seem to get it. So the signaling risk, is real, but I think most people understand it. Where it's trickier is not sort of when you have a company that has a very high price. It's when you have a company at a very reasonable price and you decide not to participate.
Because that's not a good sign. Huh?
That is not a good sign. We haven't faced that one yet.
Well, it'll happen at some point, but great question. And I think you talked a little bit about communication with your investors. Like that's Josh Felser just had an interesting post about that as well. Like boards and how to set those up and how to communicate with them. And I just think, in these early stages, you got to be talking to them really regularly.
Yeah.
Like not every day, which I once had that situation and that was very difficult, but at least once a week, and maybe a couple emails, some texts, some like you're partners in this thing, and it's it could go nowhere or it could go somewhere, right? And I like to put my investors to work. Like, hey, we really need this. Like, what can you do to help us out?
Yeah,
So,
I mean, I love that. I mean, I think sort of like investors are basically employees who have given founders money for the opportunity to go to work for them. So.
That's awesome. Needs to happen more often. All right, so that was Michael. Let's move on to Abe in Mountain View. We're a seed-funded startup with about 3 months of runway left. Things are going okay, but not great, and I'm worried about raising more money. What advice would you give us about acquisitions at this point? So we were talking about this a little bit earlier. 3 months, is it too late, or what would you?
It's easier at the seed stage because at the seed stage, sort of an acqui-hire is probably a little bit more likely.
Got it.
Strong teams are in demand, and there's sort of less G&A overhead you'd have to worry about. But I think the advice I'd give is sort of make a lot of calls.
Who should call? Like the corporate development people, or more of the product guys, like you said earlier?
Friends at any large companies.
Got it.
And they will find a way to get the word out.
Got it. And he's in Mountain View, so there's some good
there's some
likely suspects nearby.
There's some large companies down this way.
So Abe, I hope you have a great technical team or product team, because that's going to be critical. That's what they're going to want, right? And so look, I've been in your shoes. It is not fun. Make sure you're very transparent with the team about what's going on. You don't want to freak anybody out, but you need them to buy into, look, we're doing the best we can. We're beating the bushes. We're still talking to investors. But if they feel like you're hiding stuff, or if your investors feel like you're starting to hide stuff, like that's when it really goes sideways. The team walks out or whatever. So not a great situation, but just stay strong and keep working it, and hopefully it works out. All right, here's one from Rachel in San Mateo. And it says, Y Combinator just had their demo day with over 100 companies. We were both there. Do you attend demo days? I can attest to the fact that he was there, or someone looking very much like Kent was there. I don't know if it was him. If so, how do you decide which of the 100 companies to pursue? So that is an excellent question, and I would love for you to share some advice with me about that, because it's hard.
It's really hard, especially as someone who I really like to spend time with founders and to understand their motivations. You can't get a lot of that from a 2-minute presentation. It makes it a little bit harder in an environment like YC, where there are great companies, there are a lot of investors there, and usually the prices sort of like tick up over time. It almost sort of makes it a little bit more difficult to sort of be a patient investor. So like a lot of other people in the Valley, I do as much legwork as I can before demo day, so I have an idea of what to look for, who to try to get to know going in. Sometimes I'm lucky enough to have met with them. More often than not, that's not the case. But it's demo days always sort of remind me of the winner's curse in auctions, and you can get sort of very excited about sort of getting into something because everyone's competing, and we all have that competitive nature here. But sometimes the best thing to do is to just say, if I'm not 100% certain, I shouldn't be making a commitment. And as someone who is investing on behalf of university endowments and in the like, that's a decision I take very, very seriously. And so I'm cautious. If I miss something, I miss something. live with that.
There will always be another demo day from somebody. The hardest part for me is, I do like to spend time with the founders and get to know them a little bit, and that environment makes it particularly challenging because you kind of walk out in this sea of like 300 people, and first you got to try and find them. And then secondly, once you find them, they're probably already talking to 5 other people, right? And I had a situation where I didn't even meet the people. This was I won't say which incubator it was, but it was last year, and I get an email from the founder, not having met him, and he's like, can we do a quick call? So we're on the phone, not longer than 10 minutes, and he's like, so are you in or not? And it's like, dude, like, we've never met, and you should not be taking money from people you haven't met. Like, forget about whether I'm interested or not. Like, that's just bad for you. And he didn't really like that answer, and that was the end of that. But it was weird.
One of the things I try to think about sort of at every stage of investing, whether it's at a demo day or sort of at the very late stage, I try to understand sort of the motivations in the games that sort of some of the other people are playing. And see, not everyone is necessarily has the same motivations. For example, at the very, very late stage, I remember talking to a very large mutual fund family who had sort of just made an investment into a large private company. I said, God, how did you guys get to that valuation? I don't get it. And this was sort of at the start of the unicorn trend, if you will. I'm like, how did you get there? I don't get it. And I said, oh, no, you don't understand. Venture capitalists, you play a valuation game. I said, I'm playing an allocation game. This is a company that I think is going to go public in the next couple of years. My job is to get as much allocation for my public market funds as possible. And we think if we start buying early, we can show the management team that we're a good partner. So when they go public, our IPO allocation will be that much larger.
I see.
And oh, by the way, we can afford to pay at or near an IPO price well in advance. And oh, by the way, if we don't achieve that, this is one small holding spread across lots of different mutual funds.
Got it.
And that to me was sort of a great sort of reminder that not everyone always has the same motivations in investment. You have to be wary of that.
Yeah, makes sense. All right, we're about halfway through, and I need to take a moment to thank our sponsors. So sit back and relax for a minute. We couldn't do this show without the great support we get from our sponsors. For this season, it is Oric and Square One Bank, Accretive Solutions, and Ustream. So let me start out with Oric. I've been working with Mitch Zuckley and his team over there for a long time through multiple companies, and I always tell founders, like, one of the most important decisions you make early on, aside from who you're going to take money from, is who you work with as your lawyer. Yes, they are going to do your legal paperwork and your financings and your employment contracts and all that sort of stuff, but more importantly, they're going to be an advisor to you. They're going to have seen so many more transactions than you will ever see, and they're just a great resource on almost everything having to do with a startup. So make sure you get someone who you can have a good relationship with. They're not too busy for you. You like the way that they interact with you, whether it's phone calls in person, over email, whatever it is. I can vouch for the team over at Oric. If you want to find out more information, you can go check out their website. It is oric.com. Next, I'd like to thank our sponsor, Square One Bank. And so I've been working with the team over there as well for a long time through multiple banks and multiple startups. But Sam Bomick and Lori Lumenti-Gardi are the two people I know the best over there. And when you're trying to decide on a bank, you're looking for somebody who's obviously going to make sure your money's safe. That's sort of par for the course. Like, that absolutely has to happen. But as a CEO and a founder, you want to make sure that they are providing you with services that are adding value and making your life easier. So things like online banking, like having a really easy to use system for you to do transfers or receive wires or whatever it might be. or maybe a company credit card so that you're not putting all this company debt onto your personal credit card, and then someday it doesn't work out and you owe, the credit card company $20K that you probably should have been taking care of out of the company funds. So make sure you find someone great to help you out with that. You can find out more at their website as well. It's square1bank.com. It's square and the number 1 bank.com. Next, I'd like to thank Accretive Solutions, and they are the leading business outsourcing firm in Silicon Valley. And if you don't know what business outsourcing is, I didn't know either. It's basically your outsourced finance function. And I've worked with Martini Niganal over there, who is my interim CFO at a previous company, and also now with FounderLine. And they basically take over your finance operations, so you don't have to, number one, hire full-time people, especially in the early days. Number two, you're not the CEO up at 2 a.m. trying to reconcile QuickBooks and pay bills. So offload that to somebody who can handle it for you and do it very effectively, both from a time perspective as well as from a cost perspective. In my experience, it's been very reasonably priced, and you just don't want to be dealing with that stuff and trying to figure out payroll and pissing off your employees when you can have somebody take care of that for you. So you can find out more at their website as well. It's as-bos.com, Accretive Solutions. And then finally, I want to thank Brad Hunstable and the team over at Ustream. They've been on board from the very beginning. When we told them what we were thinking of doing with FounderLine, they said, we want to support you guys, and so they handle all the streaming infrastructure for us. If you're thinking about doing a show, or you have a company event that you want to live stream to an audience, whether it's employees or somebody else, they do a great job. We've been working with them for over a year now through 2 seasons of FounderLine, and it's been going great. You can check them out on their website, which is ustream.tv. So that's paying the bills, as they say. And once again, if you have a question for us, you can email us, help@founderline.com, or you can tweet to @founderline. So let's see if we can get through what we have left. We have about 23 minutes left. We have plenty of time. So this one is from Prakash in San Francisco. We are a small team and about to begin raising our seed round. Given the market conditions, what's the best way for us to go about this right now? So I don't know if market conditions will affect the advice you're about to give him, but I assume Prakash is a male, but what do you think?
Yeah, I mean, I think sort of the way market conditions probably impacts this is sort of, on the margins, like there's always a little bit of psychology associated with with the markets. We've all been hearing that sort of things are, going down. Though today they went up.
Oh, did it?
Yeah.
Oh, I had no idea.
Yeah.
It was because you were going to be on the show. I'm pretty sure
it's because nobody knows nothing.
Exactly.
But I think sort of the one thing about market conditions, just prepare yourself for it to take a little bit longer. And frankly, every founder should always prepare for fundraising to take longer than it does, or if nothing else, to feel like it's going to take longer than it does. That was certainly something I felt when I was fundraising. But I think the main thing is understand, and this is for me, but understand why you're building this business, understand how to sort of articulate how it's an important opportunity, and understand how you think, or sort of why you think it can be a defensible business. The other thing, which is always a trick question, a little bit of a trick question, but which is, how much are you going to raise? And I tend to respond best to founders who say, this is how much we're going to raise, and this is what we're going to do with it. And it just shows that you've been sort of very thoughtful and proactive about how you want to go about building your business, as opposed to, well, we're going to raise in 1.5 to 2.5 because that's what everybody does.
Got it. So it's a trick question because
I want to understand, like I want to see the level 2 thinking of sort of, this is how much we're raising because I've done this work or this planning, and I think this is what we're going to need to hit these milestones and get to such and such point at time, at which point we'll need to raise an A.
Yeah, makes sense. And And the other advice I would give Prakash is if Kent asks you, well, what valuation do you think is fair? Don't give him a number. Like tell him, well, the market's going to dictate that, and we'll, usually by telling someone an amount, you're sort of telegraphing somewhat of a valuation expectation. But,
there's nothing good that can come from, telegraphing them. If it's high, you risk scaring people away. If it's too low, well, you may have just sold too much of your company. So.
Or made you question, like, why is his valuation so low?
Yeah.
This guy doesn't know what he's doing, right? Or something along those lines. So, I don't think market conditions affect it that much, at least at this stage. And if you want to get a hold of Kent, his Twitter handle's @KentGoldman, so you can tweet to him, and I'm sure you can find his email address.
Or even better, you can find someone who knows me.
That would be good. Does that help? Is that your preferred method? Is a warm intro from?
Warm intro.
Got it. Very much, the way these things work best, and at least there's a little bit of credibility. Like, oh, I like that guy. Hopefully he's not steering me into a weird company. And don't be offended if he says no, because he's going to say no a lot, and that's true of every investor, right? And I always try to tell people, like, don't take it personally. Like, just because your new, automated waffle maker isn't what Kent wants to invest in. Maybe that's a bad example now because we just saw one of those. But like it's not a personal thing. It's a business decision, right?
Yep.
So, all right. Let's see. This one is from Toby in Seattle. What's the biggest mistake you see startup founders making? And I don't know if that's before investment or after investment, but maybe give one of each, or I don't know. What do you think he's asking there?
The biggest one is letting the burn get out of control, or letting the burn grow sort of independent of actually the core sort of feedback from the market in terms of product and market acceptance there. I think the other part is, and this is just the classic Steve Blank sort of methodology of a seed company. Like the purpose of a seed business is to go out and to understand whether or not there's a market for what you are doing.
Yes.
And a mistake I see founders make is when they become so fixated on an idea, they forget to continually do a market test, or they forget to sort of go out and sort of just refine, what they're thinking is, and sort of like they hunker down, they do a lot of great work, and they pop up, sort of, 10, 12 months later, and
the market's moved on,
there's just no fit there.
Yeah,
so I think the two things that I think are most important for founders is to understand the market, understand their customers, and then just manage the burn accordingly.
And so on the burn, like what would make you nervous? Like what things do you start hearing that like the little alarm bells start going off?
We hired 5 employees this week.
Okay.
Stuff like that.
Like willy-nilly hiring, or maybe lowering the bar, perhaps.
Yeah.
I heard from a company in an email update I just got that their burn rate was now up to 200K after having raised 200K a month after having raised like I think 1 to 1.5, something like that. And I was just like, whoa, like what is going on here?
I mean, the trickiest one, and this is really with consumer companies, when you see consumer businesses just paying a lot to acquire customers and to not sort of really know sort of what the payback is, that's frightening. And I've seen sort of like that ramp and really damage businesses. In part, again, I bring it back to this idea of sort of some of what you're trying to do is understand whether or not there's market receptivity to what you're building. If you are buying customers, you are not sort of getting the benefit from understanding whether or not there's a sort of your product is organically resonating with users.
Yep. And I think some experimentation is fine. Like if you want to test out Facebook ads or whatever, whatever.
You should know how much it costs to acquire a customer. You should know what your CAC payback period is. But that doesn't mean you should just throw tens of thousands of dollars at it blindly.
Yep, makes sense. All right, Toby, I hope that answers your question. Let's go to Bobby in LA. how often do you interact with the founders in your companies, and what value do you add in those interactions? And I don't think this is meant negatively, but so what's a typical company?
Yeah.
How often are you interacting, and what sorts of things are you helping with?
Well, it probably makes sense to actually go back and sort of mention one of the ways that Upside is different than other firms. And so the name of the fund is very deliberately Upside Partnership, and that's because actually every founder that the firm invests in gets a stake in the fund. So every founder effectively becomes my partner. And I try to treat sort of all communications with them sort of very much, not on a sort of founder, board member type level, but sort of like, we are partners. Hopefully I will help you build your business, and hopefully you will help me build mine. So that's sort of like just some of the basis for communication. In terms of the cadence at which we meet, what I always say to every founder is the only thing I'll ever be hurt or upset by is if they wanted to call me for some reason and felt like they couldn't or didn't. Like I said, I'm like, don't worry about time of day, don't worry about the day of the week, just call me if there's anything, and if it's just to sort of, talk something through, do it. I don't want founders to feel that there has to be a big thing to discuss for us to get together.
Yeah.
Usually what we start by saying is, in order to facilitate that, I say, let's put on the calendar a regular either weekly or bi-weekly call. I leave it up to them, and I call them sort of smoke 'em if you got 'em calls. The time is on the calendar. It's set aside. There doesn't have to be an agenda. There's certainly and I take no offense if the meeting gets canceled because something else came up or they're just having a busy day, but I try to make sure that time is on the calendar. There, with some teams where they may have other investors who are sort of almost hyperactively engaged, I also say to them, no offense, I'm not offended if you don't want to have those regular calls with me. Like, the purpose of these calls is because I want to understand how I can be helpful to you, how I can be that sort of like the employee that gave you money to work for you.
Yeah.
So it does vary, but most of the founders I'm in touch with probably on a formal or scheduled basis once every 2 weeks, and I always to me that's the highlight of my day when I get to talk to them. So if they call me more often than that, I'm always happy.
Awesome. And I always tell founders, like, not to be afraid to reach out. Like, sometimes there's this awkward, well, they're on my board, or they're an investor, and so I kind of need to put on a good face and show them all the rosy stuff. And you're a pretty approachable guy. I would think that when you're structuring these relationships, like, you want to know when bad things are happening as well as good things, right? And so that you can help out. And I always found that the investors I liked working with the most were the ones, like, when the shit was hitting the fan, they did not panic. Yeah. And at the end of the day, like, look, there's money at risk, and everyone's got some stake in the game, but if something bad happens, like, you just gotta move on. Yeah. You gotta suck it up and move on. And so so I always appreciate that about people. You seem like you'd be pretty, even though we've never worked together, you'd be pretty calm and say, hey, well, what can I do? Give me a shovel, let me start digging.
And some of that just comes from experience, which is you do this long enough, like, the numbers are such that a lot of companies won't work out, but that doesn't, they sometimes they don't work out despite the fact that everyone worked as hard as they could on as good ideas as they had. And so I always try to just take the long view, like, this one may have not worked out, but hopefully we'll have a chance to work together again in the future. So
sounds good. All right, let's move on to Lauren in San Francisco. Lauren says, I work for a unicorn company in San Francisco. Are there ways a startup employee can cash out some of their stock options without upsetting the company? So, great question. I think that probably narrows down the list of companies Lauren is working for, but we won't try and figure out which one it is. But what do you think?
It depends on the company.
Okay.
Sort of companies which will be sort of upset with that we'll be upset with that no matter how you do it. But there are some different avenues now. There are some secondary exchanges. There are some funds which have been sort of put in place that basically sort of work with employees to help employees sort of effectively exercise their options now and get some value for them. But most of the most credible players across all of those markets all want to work hand in hand with management teams.
Yep. And can you name some of these? Like have you worked with any of them personally? Like I don't know if Lauren can reach out to them or.
I think it's 134 Ventures. Justin Fishner-Wolfson. He was the first to sort of pioneer the sort of the funds that were actually they actually provide a loan to founders, not to founders, but a loan to employees so they can exercise their options, and they take a little bit of sort of a vig for doing that.
That's cool. I've never even heard of them. That's cool. Industry Ventures, don't they do some secondary stuff as well? And there are a couple of others. I think if you search on secondary stock or what's the best.
But again, folks like Industry, who I think the world. I mean, they and Justin will only work with management teams that have welcomed them in.
Got it. To avoid that problem with companies not liking them. So, yeah, it's a great question, Lauren, and I know. Sometimes it's hard to have like a really concentrated position. Like it might be worth $3 million on paper, but you're not liquid, and so sometimes you just gotta keep plowing through and making the company more valuable so you can get there. But great question. All right, let's move on to Marty in Dallas. How much customer traction do you need to see to make an investment in a startup? So this might vary depending on the firm. You guys are super early, so what's your thought?
Yeah, I mean, for me, it's absolutely Zippo.
That's great to hear. That's not always the answer, Marty, but in the case of Upside Partnership, it is.
But it varies. Look, it varies from firm to firm. It varies on type of investment from type of investment. I think if you're building an enterprise product, no seed investor is going to reasonably expect that you have customers sort of like bought in,
deployed,
already. The consumer side, it varies. It also sort of depends on sort of what the credibility of the team is. Obviously, sort of people who've done it before can get away with having less traction, and that's not always the right answer, by the way. But I mean, that's so I'm not sort of like endorsing that viewpoint. That's one of the reasons why like I don't worry about whether or not a company has traction. It's something that I purposely don't ask, but that is the way the world works.
Yep. And you guys are typically like in a big percentage of your investments, I'd imagine you're either the first money in or in the first syndicate of 3 people putting money in or something, and in those cases there's probably not much traction to begin with, right?
No.
It's although I have met some investors who want to see like a lot of users on no money, and I find that a little difficult to totally understand.
And that was one of the reasons why I started feeling like I had to start this fund, because friends of mine who are founding companies are coming back from these meetings where they say they're going out to raise their seed fund or their seed round, and they say, well, we want to raise $800K to $1 million. And funds were telling them, that's great, but unless you're raising 2, it probably doesn't make sense for us to be talking to you. And so then they go, okay, so we'll raise 2. And then they say, well, if you're raising 2, we need to see traction. And the founder's like, but I'm raising my seed fund so I can get the product, or my seed round so I can build the product to get to market, so I can get traction. And it's like, that was the gap I saw that hopefully fill in a little bit.
Makes sense. All right, sounds good. Let's move on. This one is from Jake in Santa Clara. I've been working for 3 years in a large technology company. I've been weighing the pros and cons of joining a startup versus getting an MBA. Do investors value MBAs? What would you recommend I do? I know some investors do not value MBAs, but what do you think?
I mean, this is going to sound a little bit platitudinal, but make those choices for yourself. Don't make them for someone else. If you want to go to school and you want to sort of either learn about business or be in a business school environment for a couple of years, by all means do it. I don't think you won't regret it if that's why you're doing it. If you're doing it because you think it might set you up for whatever is next, well, then you may be disappointed. Similarly, on the same side of joining a startup, don't do it just because you think it will give you your sort of like startup badge. But startups, some of that comes because, as much as we like to sort of glamorize startup life, it is really hard. You take less cash comp, you deal with risk. The risk that sort of your company could shut down any day. You don't have that certainty. You work really, really hard, and that's just sort of like that's a big price to pay unless you're really ready for it. And so I would say, don't think about joining a startup to just join a startup. If you're going to join any company, do it because you believe in their mission, because you believe in their product, and you want to contribute to it.
I think that's great, and I go back and forth on this. I know there's somebody, might have been Paul Graham, who said like the valuation of a company is like we do plus 500K for each engineer and minus some amount for every MBA, and I think that's a little unfair.
In Kasser, who just became who everyone loves, who just became the COO of YC, has an MBA.
Okay.
So I mean it's.
Well, that's because Sam's running it now. So no, I'm just kidding. Anyway, I go back and forth on it, but there've been a lot of people who have done startups who don't have MBAs, and others who do. So, but I love Kent's point about do what's right for you. Like, don't just do it because your girlfriend wants you to do it, or somebody else. You saw somebody on TV talking about it. Like, do what makes the most sense for you. So I know it's dodging the question a little bit, but I think you're absolutely right.
Actually, I don't think it is. I think that is people do their best work when they're intrinsically motivated. So if you want to have a successful career, it does start with sort of like know thyself.
Yeah, absolutely, and don't let people on webcasts or podcasts make career decisions for you either. So that's another point. All right, we got time for one more. This one is from Mike in New York. This one is how does your firm find potentially talented entrepreneurs outside your first or second degree connections?
It's a great question. That's actually where I found some of my favorite companies.
Oh yeah?
Yeah.
How? Like what's a good example of?
So early on with the fund, I think it was about 2 or 3 weeks after it closed, I made a trip to LA, and I sent I was going down to meet with the folks who run Amplify down there, which is a accelerator and investment fund. And they were having a demo, and I said, look, I just started a fund. I'd love to just come in, hang out, and meet some folks. And I was proactively asking them. And there happened to be a founder there who wasn't really raising at the time, who wasn't really associated with Amplify, but they needed to fill some spots, so she was there. That founder's name was Laura Fine. She was the founder of a company called Laurel and Wolf. I was able to sort of, put sort of like the last little bit in their friends and family round.
Oh, cool.
A couple months later, they went on to raise, a Series A from CRV, and they're just building a phenomenal business. She is the absolute prototype of like a purpose-built founder. It's a marketplace for interior design services. She used to be an interior designer. She understands the problem the way no one has, and that's sort of reflected in the business. And that's something that I never would have gotten, had I just sort of stuck to the Valley knitting.
Got it. Awesome. And as you said, like come in through a trusted resource if you can, because that increases the odds that you're gonna look at it, right? So, we're out of time. Thanks. Awesome
Thanks
job.
for having me.
Absolutely. And you can follow Kent on Twitter. His handle is @KentGoldman. And is there one for the firm as well?
@Upside VC.
Got it. So that's all for today. Tune in next week for another episode of FounderLine. Our guest will be James Joaquin, who's the co-founder and managing director of Obvious Ventures. James is an old friend of mine. We've done a number of companies together. He's been involved in Apple and When.com, Ophoto, and Zoom. And he's also been a venture capitalist since 2007, investing in companies like Plum Organics, 10 Marks Education, and O-Power. That's next Wednesday, September 2nd at 5 o'clock Pacific time. Thanks once again to our amazing sponsors, Oric, Square One Bank, Accretive Solutions, and Ustream. Don't forget to follow us on Twitter. Our handle is @FounderLine. You can send us questions in advance via email to help@founderline.com, and we'll get those ready for James next week. You can also go to our website and check out previous episodes, read more about the upcoming guests, and subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next week.